Hello and welcome to today's webinar, which is hosted by Vincent's Chartered Accountants with our very special guests from the Restaurant and Catering Industry Association. We have Estelle, who's our member representative in Victoria, and Jason, who's the member representative in Queensland. Thank you both for taking time this afternoon to have a chat with us.
Thanks, Louisa.
Thanks, Louisa. It's great to be here.
So this afternoon, Estelle and Jason are talking with Henry McKenna, one of the directors at Vincent's, and myself. We'll be talking all things money and small business, especially as it relates to the Restaurant and Catering Industry Association's members, who are primarily hospitality owners and operators. There's lots going on financially in the world of the members at the moment, and we'll be looking at 5 to 6 of these areas with Estelle and Jason. So let's get underway. We've asked Estelle and Jason some of the questions that members are speaking to them about, the questions in areas that is, and we'll be discussing some of them here today. So over to you, Jason. What are you hearing at the moment from members?
Thanks for that, Louisa. Look, very good and very timely coming towards the end of the financial year. What we're seeing at the moment is there's a lot of our members have labour shortage in the current market. Many businesses are already offering above the minimum wage to retain staff, if they can even get staff, that is. Then obviously we've got the 5.2% increase in the minimum wage. What are some ideas that for our members and their businesses to manage this wage cost going forward?
Yeah, labour's probably the number one issue in the restaurant and catering industry and the hospitality industry generally, as well as many industries across Australia at present. It is such a huge area of challenge because every business owner knows that they have to have good staff if they want to have a great business. However, costs are rising and there is a shortage of staff at the moment. So just a few ideas from me. The way I describe it is I'll put a few ideas in the buffet because not every idea will suit every business. And it's also too simplistic to say that these are the only ideas that will help a business with the current labour issues. So I'll start by putting some dishes on the buffet, and then I'm keen to hear what else you guys have heard and what you guys have heard owners and operators doing as creative solutions and really good solutions, different solutions in relation to labour as well. So for some of the things, looking at rostering, how is the rostering going? Is there optimal use of an employee's normal labour hours? Like, is there good planning and good scheduling behind the roster? So, for example, when are the busiest times for that particular restaurant or hospitality business? And are the right amount of staff on then? Because you don't want too many and you don't want too few. So looking at bookings, looking at systems and processes also. Are the team members doing the most effective things they can be doing? Is front of house adequately staffed but not overstaffed? Is back in the kitchen, is that sufficiently staffed or not? Where are the bottlenecks? And looking at it as a flow of work, flow of time, flow of labour and flow of information to work out what an optimal staffing level is in a business. Also, having a look at flexible work and also non-traditional sources of employees. So while it might be very common to ask around friends or put up an ad locally, what about people who aren't local, or they might be in, say, local training colleges or local high schools or other locations where perhaps as business people we haven't traditionally recruited out of but could be potential sources of employees. Now, there are just a couple of dishes to start. Any thoughts so far from what you've seen members do, Jason or Estelle?
Yeah, I think your first point, Louisa, is really interesting about having the right staff for the right time. I can think of lots of venues that I've worked in that I'm sure did not have a costed roster. Just those foundation blocks of having a forecast and costing a roster polishing cutlery at 10 p.m. on a Sunday is not the best use of time. You're probably better off to get someone in at 9 a.m. on Monday to do that, just because of that cost involved on those penalty rates on the weekend. So certainly working smarter, not harder, is something that I wholeheartedly can get behind. And really looking at, where you need to put your marketing efforts as well. There's not much point in putting your marketing money into a Saturday night when you're already full, but perhaps those Monday lunch times when you're empty is where that kind of money is better spent. So I can certainly relate to the smarter, not harder approach to rostering and in the business. And I think that's a really, really important point.
Definitely so. And anything you've seen your members do, Jason?
Yeah, look, I'm agreeing wholeheartedly with Estelle. Rostering or planning your roster is a very smart way, rather than just ad hoc and trying to shoot from the hip. You're going to fail to plan or plan to fail, really. One thing that you did mention is trying to find staff. We've seen in the news recently about government or federal government thinking maybe looking at older pensioners going forward. I think that possibly could be something that may assist down the track. I'm sure there's quite a number of highly qualified hospitality staff sitting at home in that pension sphere that wouldn't mind getting back on the tools. Who knows? That it could be a blessing.
That's a great idea.
Yeah.
Again, non-traditional places for staff, hey?
Correct. And let's just hope government does do something about that. It works well in New Zealand, and I can't see why it can't work here. I think I've been an advocate of that for many, many years, that should allow the older people to supplement their income, their pension income, be it government-based or through their own personal super, to contribute again to society.
I think a lot of these things haven't been well explored in hospitality because we haven't had the need to. The idea of job sharing or, parents being at work, they haven't been well explored. And I think that need to explore those things now is really driven by demand. And I think that's a really interesting space to play in. I mean, I've been helping out at a restaurant recently because I loved that part of my background, and I'd, skip into work there at 5:30 because I was excited to be there, and I do it 2 or 3 nights a week, and I was probably a model employee. Not to toot my own horn, but I thought I was doing a pretty good job. And because I was getting out of the house, I was getting away from my young family, and those sorts of employees haven't been well explored, I think, to date, because that flexible hasn't been needed. So it's a really exciting time, I think, in that way.
That's
sometimes situations of change can cause positive outcomes. Change doesn't always have to be negative. So I think adapt with what you can and work with what you can. And if you need advice, seek professional advice. Contact Vincent's if you've got questions in this space. They can help you.
More than happy to help. Taking up one of the points Estelle mentioned about, does the cutlery really have to be polished at 10 p.m. on a Sunday night? That goes with admin work as well, because sometimes, often, there will be admin work to do as part of running a restaurant, catering, hospitality business. And is that perhaps best done, again, Monday morning when it's a bit quieter, rather than, say, on the weekend when it's really busy? Also looking to see what other things can be automated. Can the rostering be automated so it doesn't have to be done by the shift supervisor or the manager? And streamlining the actual workflow processes itself so that the employee's time is the most effective that it can be for when they're there.
Yeah, absolutely. I think that's a really interesting point about the administration, Louisa, because, my background, front of house hospitality, I've been at work until 1 or 2 a.m., doing cash up, sending it off to accounts on a Friday, Saturday night. And I know that the accounts team don't look at it until, Monday afternoon, if not Tuesday at best. And probably I'd never even thought of that it's not necessarily an effective use of time, especially when your brain is exhausted at that time of the day. It's not the most efficient use of anyone's time, I'm sure.
Unless there's a lot of cash to put away, of course.
Absolutely. There's some fundamental things that would have to be done without a doubt, but the reconciliation of actual versus the computer takings,
True.
I think everyone with fresh eyes in the morning would do better at that once everything is securely put into the safe.
So Estelle, what have you been hearing from some of your members as well?
So second to staffing issues, because that's without a doubt the biggest thing that people have been talking about, is the cost of doing business. There are a number of factors that are affecting cash flow and profitability in hospitality businesses. If you haven't heard about the rising energy costs, then you must have been not engaging with the news media in the last 2 weeks. But cost of fresh produce, I go to the supermarket, it's $12 a kilo to get broccoli. So there's all kinds of other types of costs of doing business, and what can businesses do to be profitable and keep cash flow positive? I guess maybe Henry, can I throw that one to you?
Sure. Can you hear me okay? Okay, thanks. I think it's fundamentally important to understand all of the costs in a business, to sit down and work out what they are. It's not just the input costs of maybe the beverages or the food. There's a lot of things beyond the direct costs of sales. So it's a good idea to sit down and write those all out. So you'll have your rent, you'll have your wages, you'll have insurance, you'll have taxes, you'll have utilities, and the list will go on. Once you've got that list, try and cost them up and work out what exactly they'll be, and try not to be too optimistic about that, and put in a contingency amount as well, because you can guarantee that there'll be some costs there that you haven't thought about. And they also understand the timing of when they need to be paid. So not all payments need to be paid immediately. Some will be paid on 60-day terms. Some will need to be paid up front. Things like taxes will be paid sort of periodically. So understand the timing of those. Ideally, you'd put them all into some sort of basic cash flow forecast spreadsheet, so you can understand when those costs have to go out, and also have an understanding of when the revenue comes in as well. Once you've got your understanding of the costs of the business, that will then help you set up, determine the sales prices that you need to set to make sure that your business is profitable, and see if you can match the inflows of cash into the business with when the cash outflows go. And if there's any gaps there in the timing, go and look for some financing to help you get through those, whether that's a loan from family or friends or a bank overdraft, or even a use of a credit card, to make sure you can get through those times when you might have a cash shortage. But hopefully, if you're pricing your products well, you won't have that shortfall. Very important not to forget about the costs that need to be paid in the future. The one that people always forget about and defer is the ATO, the taxes that will need to be paid in the future, whether that's pay-as-you-go withholding tax, payroll costs, or GST. Very easy not to pay the ATO because they don't demand it immediately, but the ATO won't go away and they'll need to be paid at some point in the future. And it can be quite costly if you need to pay additional penalties and interest. Too often we see businesses go under because they've spent money that should have been put aside for the ATO. Also trying to have a breakdown of what you're selling in terms of what you sell it for and what it costs. Not all sales are good sales. Sometimes you might have products that you're losing money on. You might be better not to sell those products, whatever it is, whether it's a particular menu item or a package of food. Another thing in terms of cash flows, it probably follows on from what Louisa and Estelle were talking about previously. Understanding the demand levels in your business and when you need the staff. Staff will be one of the biggest costs, and it's a cost that's going up. So there's no point paying for staff to be rostered on at a time when you're not busy in the business. There might be other ways to increase sales as well. So, for example, we see restaurants that do outside catering. We see mobile lunch delivery services for cafes that don't have a particularly big footprint or want to serve more customers. Some businesses go into selling merchandise or groceries. We've seen quite a bit of that in COVID times. Businesses try to pivot to try and get revenue in when they've been forced to close. A couple of other things I have down here. Try to maintain low inventory levels if you possibly can. Just because you see a good bulk price on an item, it doesn't necessarily mean you need 2,000 rolls of toilet paper, unless you're going into a pandemic, in which case you might want to hoard a few. The other thing to help with cash flow is to ask for extended payment terms yourself. Maybe you're on, payment within 7 days. Maybe so you can extend that out to 30 days. And at times when cash flow is tight as well, maybe you just defer the payments. So maybe the payment terms are what they are, but just pay when you can afford to pay.
I've made so many notes on your response there, Henry. We could have a webinar just in that, I think. Some really, really great points there. One of the first things that you said that really resonated with me was establishing a cost first of doing business and then working out a price. I think that a lot of people have that the wrong way around, where they work out a price and then they realize they're not making any money, and then they go backwards and do the costing, and probably have their eyes really, wide open from that point on, because I'm sure that they'll probably go, well, actually, I'm not making any money on any of these plates that I'm putting onto people's tables. And that kind of comes from the creative kitchen team, I suppose, rather than the smart, savvy business person at times, and how there's the need for both of those in a hospitality business.
Yeah, you need to get the balance for sure.
Yeah. This is something that I've always thought, that a hospitality business is a production department with a sales department attached. And I think that there's a lot that people can get from their team by looking at them like salespeople rather than hosts. And I'm curious to hear what you think about that space, and if you think that investing in people's training to be more like a salesperson is something where that increase in revenue could come from as well.
I'm not sure whether driving sales necessarily is always a good thing. I think it's better to maybe invest the time in doing some basic management training and potentially some financial training to understand, the fundamentals of running a business. It's not just creating a good product. It's actually you're there to actually make money. But driving sales, yes, very fundamentally good, but understanding the profitability of the business, I think, is the key thing.
Yeah, it's very interesting.
Louisa.
Yes.
Henry talked about borrowing money for cash flow. So a lot of businesses, a lot of hospitality businesses, to be specific, have borrowed over the last few years with interest rates that have been historically low. What should businesses be aware of when considering whether to take out a loan to assist with cash flow in their business? And should businesses, if there's stress in making repayments, where should they turn to? Who should they look to? What's your advice in that?
Yeah, this is a really important question, because in some ways, a business loan can look very attractive, and it can sometimes be the right answer. However, sometimes it looks like an easier fix than it is. And sometimes business owners can be so focused on the short term of getting this loan to get them through a certain period that sometimes the longer term consequences to the business might not be given as much weight as perhaps they should. So it's not a yes, it's always a right answer, or no, it's always a wrong answer. The answer is it depends, but these are some of the factors that I'd recommend businesses consider in thinking about whether to take a loan out. I'd recommend that the business owner thinks really clearly about the purpose of the loan. What is it for? Is it to fund working capital, which is the just everyday running of the business, because sometimes there's a bit of a timing difference between when we buy supplies and when we cook it up, when we collect the money. Or is it to invest in a certain piece of equipment? Or what is it for? To open a new location? So is it for fit out? Because whatever it's for has to be worthwhile, which means it has to either generate enough money or generate an incremental amount more of money in order for it to repay whatever we're doing with the loan money. Now, having said that, we've talked a fair bit about cash flow so far. Now, I should say, if you're a business owner and the numbers are not your thing, that's okay, because not everyone's thing is the same. We need some people who are good at the money. We need some people who are great at putting great food on the table. And sometimes that's the same person and sometimes it's not. And either way, that's okay. We're all made with our strengths. But if it's not, it means somebody needs to be in that role. So that can be the business bookkeeper. It can be, if it's a larger group, whoever's in the finance team. It could be the accountant for the business, but somebody needs to be in the role. The chair can't be empty. So if you don't like doing your own cash flows, or spreadsheets sound like the worst thing on earth, get somebody else to fill that role for you. So have a look to see if your business can afford the loan. Now, just because the bank will offer a certain amount of money doesn't mean that's the amount you should borrow. So it should be done based off a calculation of what the business can afford to repay, because there's no point solving a problem now or for the next 3 months if it's going to put you in severe financial stress 6, 12, 18 months down the road, because you're now deferring the problem rather than actually solving it in a sustainable way. Have a look also at the, so that's talking about repayment, but also have a look at the total amount being borrowed. Does it make sense in the context of the business? What proportion of the business's sales and profits are needed to repay the loan? So we're talking about like a repayment period here. Another thing to consider is, are you putting up security for the loan? Do you have to let the bank take a mortgage over your own personal home in order to get this loan or not? Or is it just secured against, say, the equipment that it's financing? What's the interest rate? Is it fixed or variable? If it's variable, can you afford it if it goes up? Because we are in an environment where interest rates are going up. And what are the fees and charges associated with the loan? So they're just a few thoughts about getting a loan. Any further comments about evaluating the decision to get a loan?
Well, I think for me, talking about the cash flow, talking about lending, would be prudent to go speak to your financier first, find out what you can borrow that is prudent, then go back to your accountant and discuss with them, looking at the books going forward. Look, I've been offered a $100,000 loan to cover new equipment, say. The accountant might say, well, look, your cash flow at this stage, I don't think we can borrow $100,000. Let's look at 50. In other words, don't bite off more than you can chew. And then there's the sleep factor at night. You want to go to sleep at night knowing that you're safe, you're comfortable, you don't be stressed out about borrowing too much money, because you're right, Lloyd, the interest rates are going to go up. Inflation is we could hit 7% by December. So there's what I call the sleep factor when it comes to borrowing money. What do you think?
Absolutely agree, because what we're trying to do through our conversation that members are listening in on is to relieve the burden, because we already have an appreciation of how much is on the shoulders of hospitality owners and operators at the moment. So there's no point recommending something which is a short-term fix but a long-term stress, because we're not really helping then, are we?
No, it's true. Look, having a good relationship with your financier and your accountant is paramount. If you don't, start it, in my books.
Exactly.
You're a business first and a restaurant second, because the restaurant won't exist unless the business is sound. That's
very solid, and that's a very quotable quote, Jason. I like it.
You can use it.
Thank you.
I might suggest...
Oh, sorry. Go, Estelle.
No, Louisa, you please continue.
I was going to say that very nicely segues into what happens if there's a bit of stress or you've missed a payment or something like that. So before I segue into that, did you have a comment, Estelle?
I was also going to segue into another question, which was actually the other side of the coin. And that is that, you know, some businesses aren't struggling with cash flow. Some are doing very well and are expanding even. And I guess some of these owners and operators are looking to buy more businesses. But they maybe aren't doing it the best possible way. And I've heard about people buying businesses but then somehow lose a family home because they just haven't set up the business structure correctly. So I guess I just wanted to ask you, Henry, I know that's a good area for you, is how does someone prevent this from happening to them, where they end up overexpanding because they are doing well in business and potentially have personal liabilities?
Okay, thanks, Estelle. You can still hear me?
Yes.
I'm just not sure if I'm covering up my microphone, so hopefully I'm not. Okay, thanks. Yeah, there probably are some good businesses out there to buy at the moment, fundamentally good businesses, but they're being forced to sell because of the impact of COVID with closures and lockdowns, etc. So there's probably some good bargains to be had. In terms of people losing their homes through business failures, this is usually tied to how the business is set up and also how it's financed as well. So whether you need to borrow from a bank or some financial institution for the initial setup costs. So if so, what are the payment terms? And probably most crucially, and this is why people end up losing their homes through business failures, is whether there are any personal guarantees that are given to that lender. And so before going in and signing up to borrow that money on those terms, is it possible to avoid those personal guarantees? And if it's not with your existing lender, then can you go to somebody else? Or could you borrow that money from friends and family who are going to be more understanding if things don't go well? And this is probably where I didn't chime in on the last question, but I think it's also useful to employ a finance broker when you're looking at your financial products that you want to undertake, and to find the right product that's for you. The other thing that we see that drags people personally into a business failure is when the business owner has signed a lease that's got onerous exit clauses. Usually, in the past, landlords have asked their tenants to provide personal guarantees, and everyone goes into a business, with a very optimistic outlook on what's going to happen. They don't expect it's going to fail. So usually, you're just keen to have found the right property. But signing a personal guarantee to a lease can be extremely detrimental to your personal finances, particularly if the business fails, say, after 1 year into a 5-year term. Well, the landlord's got a right to claim personally for the unpaid rent for the remainder of the lease, and a make good element as well. So really, people should be trying to push back on those personal guarantees to landlords. And usually landlords, particularly in the current environment where there's a lot of vacancies, will probably be open for that. It might mean that you might need to pay a slightly larger bond, so maybe 6 months, a 6-month bond as opposed to a 3-month bond. But to me personally, in terms of being able to sleep in bed at night, as Jason was saying, I'd prefer to know that I might be foregoing a 6-month bond rather than potentially being personally liable for the whole of the lease term. And there are also some pretty good tenancy advisors who are out there as well. The restaurant and catering, I think one of their partners is LPC Cressa. Yeah. This is exactly what they do. They advise tenants before they sign up on a lease, and try and push back on some of these tougher terms. The other thing you might want to do is spread the risk. So rather than going out on your own, maybe go into partnership with a few other people. That way, if things do go sour, then at least other people are sharing the risk. I'll go back to my original point from the earlier question as well. Is is to have a cash flow up front and make sure you understand what the businesses look like, and understand that, there'd probably be a period of ramp up where you're not maximizing your sales straight away. So if you do your cash flow up front and it doesn't look like it's going to be a profitable venture, then maybe stop at that point. Try and keep costs down as well. Try not to be too lavish, I would say. So the initial fit out maybe don't go as fancy as you might want to. And then if the business is successful, then maybe build on it and upgrade as you go. And the other final point I'd make is to, when you set up the business, do it in a corporate entity. So you're dealing as a company rather than a sole practitioner. And it would be a good idea if you have multiple venues, so you're opening more premises, is probably to put each one in a separate corporate entity, a separate company. That way, if one of them fails, then it doesn't bring down all of the others as well.
Just a question on that point, Henry, from a non-business person. Those separate entities, they would all have their own separate ABNs as well. Is that right?
They would if they were trading as a business. Yeah.
Yeah, that's interesting. The reason I asked that is because a lot of the stimulus through COVID pandemic was done based on the number of effectively businesses that you had, and some businesses that had one ABN but operating multiple sites were only eligible for one set of stimulus, whereas if they'd had 10 different ABNs, they would have been eligible for 10 amounts of stimulus. And they said that it was a more simple business structure just to have one ABN with multiple sites, which is why they did it that way. But it seems like there might be a lot more benefit to having them under multiple corporate entities separately than under the one.
I think that's probably just a lucky win for the people who had multiple ABNs. But I've seen many retail businesses and also hospitality businesses where there might be some really good businesses there, but there's a few more operated by the same company that just brings everything down. So if you can separate the business and its assets into separate companies, and you might even put the employees in a totally separate entity together, and then those employees can provide their services to each of the other companies. But that's probably for when you're getting into a larger operation with multiple sites.
Yeah. Perhaps when we're talking about multiple locations, I can put a question to you, Louisa. Some of our members have locations that are performing better than others. And I think Henry has touched on this slightly, but what are their options for exiting some of their leases, and what are the potential consequences for them personally and for their businesses?
Yeah, sure, Estelle. Yes, Henry's touched on it personally, but I'll do my best to give it a little bit more detail if that's helpful. So with leases, the exit of leases depends very much on how the conversation with the landlord goes, because the landlord is the other side of the lease. So if there are some performing locations and some underperforming locations, the last thing you want is for your performing locations to be cross-subsidizing your underperforming ones for too long. So a few different things here. Firstly, there's negotiation with the landlord. So talking to them, explaining that this site is, you're struggling to make it perform. Is there a possibility of exit? What would they require for an early exit? And we've seen a whole range of responses come back. Everything from, we'll take your bond. You've been a really good tenant. We think we'll be able to release this quite easily. If you let us take the bond and you exit and leave the premises in a certain agreed condition, then we'll let you out. Now that is absolutely amazing. And before the last couple of years, it was virtually unheard of. But it has happened sometimes. I have spoken with various clients who thought they might need to go under, but then they were able to get out of their non-performing locations without needing to go under, which was fantastic. On the other end of the scale, there is, of course, the landlord who says, no, we're going to hold you to the lease and to every dollar and cent in the lease. And so if you exit, this is going to be the cost to you. And if you've personally guaranteed the lease as the director, this is going to be the cost to you personally as well. And it can be hundreds of thousands of dollars and the directors are saying, well, if I had that money, I wouldn't be having this conversation with you in the first place. Now, so negotiation is one option because it sometimes does work, but it doesn't always work. Another thing to look at is to see when the leases are due to expire, because sometimes there's the ability to just let them roll off and not renew. And in that case, there tends to be less cost in exiting because the lease is actually at the end, which might be fine if you have 3 to 6 months left on the lease and you think you could survive those 3 to 6 months. Obviously not so viable if there are multiple years left on the lease. One of the other things that sometimes people may not have heard of is this feature called a voluntary administration. So you can actually put your company or group of companies through a formal restructure process. And as part of that formal restructure process, there's the ability to release underperforming or certain leases and retain other ones through the process. Now, as part of this, there needs to be some offer made to the landlords who the company owes money to. Usually it's some cents in the dollar type of payment, which if enough of the creditors vote for it, will be something that all the landlords and all the unsecured creditors must abide by whether they voted for it or not. Having said that, more than half of the creditors in what we call in number, which is just by counting the creditors, or more than more than half of the creditors in value, that is value of the debt they're owed by the company or the group, have to approve any debt compromise in order to bind them and the other unsecured creditors of the company. So just know that there is a way. It does get a bit technical, but I've tried to put it in a bit of a nutshell as to some of the things people can do about leases. What are you guys seeing or hearing about landlords at the moment? Are you hearing them that they are negotiating or being more willing to negotiate? Or are you hearing of a lot taking a hard line at the moment?
Definitely the former in Victoria, especially in CBDs and things. We have been seeing some really good stories come of it, but there is the other end of the spectrum as well. It's a very tough time in CBDs at the moment, without a doubt, where working from home and hybrid work environment hasn't really seen the reinvigoration in those spaces that some of those businesses really need. But the local councils and things are also doing a very, very good job to try and bring stimulus back in other ways with events and major events and that type of thing. But I think the negotiation is the one that people do kind of approach first, and the voluntary administration was not something that I knew about, lawyers. So I'm learning something from you today. So thank you. It's very helpful.
Yeah, Queensland's about the same. I think the key word is negotiation. And as we've mentioned, one of our other key partners, LPC Cressa, they do specialise in that whole process of leasing, whether you're getting into a lease, whether you want to get out of a lease, or renegotiation. Always seek the professional advice. Don't try and do it yourself. You're running a restaurant. You're not an expert in leasing. You're not an expert in banking. You're not an expert in loans. You're not an expert in accounts and bookkeeping. So it's just so important when you're a business owner to seek professional advice on everything you do, because it's your livelihood. So get it right the first time. Measure twice and cut once. That's what I'd be doing.
It's very much that. And it actually links very much to the question from Jason earlier about what happens if you are finding stress in, say, loan repayments, that it applies to lease repayments as well. And it's almost counterintuitive. It's to approach the landlord or the bank or the financier early, because most people are like, the bank is big, the landlord possibly is big. They might not notice if I miss a payment or two, or it might take them a while to come around. Banks and landlords don't like to be treated like that. And we have to remember that there's humans on the other side of these transactions as well, even if they feel like a big institution sometimes. And it's better to go and say, look, I'm having a bit of a squeeze because, and just explain the reason. The beauty about honesty and truth is that it exists. And so if you're going through it, tell it to whoever you need to tell it to. Because when you approach them and say, look, I think I'm going to have trouble, say, for the next 2 or 3 months, but I think it'll pick up, by about September, October. What can we do? What can I do? What can we do? What are the ways you can help? I am interested in trying to make the repayment to make this work, but this is my situation at the moment. It absolutely feels counterintuitive. That applies to the ATO and tax debt as well, by the way. But it is always the best way to go.
Well, actually, Louisa, speaking of the ATO tax debt, Henry, what's Vincent's got planned with the recent announcements?
Well, I think Louisa and I are planning to be a bit busier than we have been for the last 2 years as a result of what the ATO is expected to do and has started to do. The ATO is owed a staggering amount of money at the moment. The numbers change all the time. The last I heard, it was about $60 billion, although they estimate, I think, that it's...
is that business debt, Henry, or personal and business?
That's a combination of both, but most of it, I think, is made up of corporate debt.
Right. GST included in that?
Yeah, there'll be all taxes included.
All taxes.
In that. All taxes, so PAYG, withholding tax, GST, superannuation, income tax, everything. So there's approximately 60 billion, or at least $60 billion is owed, of which I think they estimate that something like 35 billion might ultimately be collected. To put that figure into context, about 3 or 4 years ago, when the debt level got to $19 billion, there was a huge push by the ATO to start collecting that in, because that number was seen to have blown out and it was inexcusable. So we're now at sort of over 3 times that level. In normal pre-pandemic times, there's an ATO collections area who've got a number of processes that they do to collect money in, where they sort of escalate the pressure on the debtor. So they issue various letters. They issue a nice one on green paper, then there's another one on blue paper, then you get a red one, and then ultimately you might be issued with a director penalty notice, which I'll go into in a bit more detail in a bit. You might be able to do some sort of payment arrangement. That's something that they try and do to get money in. And after the ATO sort of run through their options and got more and more aggressive, lastly, what they'll do is they'll have a business wound up, they'll put into liquidation, and for an individual, they can be bankrupted. So since COVID started, so from about April 2020, the ATO has backed off on all their usual collection processes, as the government didn't want to be, or wanted to be helping people and businesses that were going through difficult financial times. But now the lockdowns are over and forced closures of businesses are over. The ATO, and we've also got through the federal election, the ATO is now looking to recover some of that spiralling tax debt. So letters have started again, and they're getting more aggressive. They're threatening. They're threatening to issue director penalty notices to directors, although I haven't heard of any being issued quite yet. So, as I mentioned earlier, the ATO debt doesn't go away. It's just very slow to chase it normally, and it's been incredibly slow to chase it because of the pandemic over the last couple of years. But they're ramping up their collection activities.
Sounds like the long arm of the law will eventually get you.
That's right. That's right.
May not be tomorrow, could be not next week, but they'll eventually turn up on the door and start knocking. That's
right, and they won't do deals as well.
No.
If you owe $100, they won't offer to settle that for $20. They might offer to settle it through the voluntary administration process that Louisa mentioned just previously, but they won't do a settlement with a company that's outside of an external administration.
Henry, if you go down that voluntary administration process, then that puts you in a bad stead going forward to opening up a business again. Is that correct?
Well, there's a couple of different outcomes that are likely through a voluntary administration process. One is that the company can end up in liquidation, and that can have a negative impact on your credit rating. The other outcome of a voluntary administration is that a deed of company arrangement is agreed with creditors, and that's the compromise that Louisa was talking about, where you might offer creditors a few cents in the dollar. And if a deed of company arrangement is agreed upon and is complied with, then the company comes out the other side and avoids liquidation. So there won't be a blemish on the director's name for a company that's gone through that process. Yeah. I did touch on, I mentioned director penalty notices. I just want to explain a bit about what they are. So a director penalty notice is issued by the ATO when it believes it's owed money by a company, and the director's not responding to the request for payment. And what effectively it is, it's a letter that says to the director, you owe this amount of money, or the company owes this amount of money. You've got 21 days to do three things. You can either appoint a liquidator, or you can either pay the tax debt if you can afford to, but that's unlikely, or you can appoint a liquidator to the company, or you can appoint a voluntary administrator to the company. And if one of those three things is done within 21 days, then the director can avoid personal liability for the unpaid debts. And the tax debts include GST, PAYG withholding tax, and superannuation. If one of those three steps isn't taken within the 21 days, then the director can be made personally liable for the debts of the company. And it's 21 days from the date of the notice. It's not 21 days from when the director receives the notice, which with the postal system nowadays might be sort of 7 to 10 days after it was issued. That's at a very high level. Director penalty notice is a bit more complicated than that. But if any of the people on the webinar receive one of those, they need to seek some advice immediately.
It sounds good advice there, Henry. Look, going back to what I said earlier, when you're in business, you must seek professional advice from a variety of different areas: your lawyer, your accountant, your banker / broker, whatever it might be, because don't turn into an ostrich, put your head in the sand thinking that it's all going to go away, because it won't.
Yeah. Well, that brings us to the end of our pre-prepared questions. If there's any questions, please do put them in the chat and we'll address them. If there's no questions, what I might say in a concluding wrap-up is, Jason and Estelle, is there anything else you'd like to say based on what you're hearing from members? You're at the coalface, you're talking to them on the phone, you're out there meeting them. Anything else that you're hearing that might be of help to the people listening today?
Estelle?
I think there's been so much in today, and thank you very much, Louisa and Henry, for your time and putting this together with us. I think we should do it again soon, because there's certainly lots more things to kind of talk about. But I guess probably the only other thing that I could really talk about, I actually think we've covered it really well. The three key things: staffing, cost of doing business, leasing. Those three things are so important to our industry at the moment. So I don't think I do have any other questions. I think you've done so well in answering those three things. So thank you very much.
Thank you so much. And Jason?
Thanks, Louisa and Henry, and on Vincent's as well. To everyone here on the chat, the webinar, look, again, I'm going to reinforce, if you have any doubt, please speak to people in a qualified position before you make a decision. They are there to help you. Vincent's great partners of the RCA and LPC Cresta in that leasing space as well. It's been a great webinar, brilliant pieces of information from both of you, and thank you, Estelle, as well, for your input down there, and Vic. cold as it is down there. And yes, look, please, if you are a member of the RCA, please go to our website and check all our business partners. We have over 50 of them, and they're all there to help with their products and services. If you're not a member of the RCA, please go to our website and follow the prompts to become a member. We're here to help. We're non-for-profits. We're not here to make money. We're here to help the industry.
And you do a very good job of it. So Estelle and Jason, thank you very much for speaking with us. Absolutely keen to do this again. Henry, thank you as always for your input. And if any members listening to this have any questions that come out of it, feel free to reach out to us. Just hit reply to the registration link and we'll be more than happy to help you out as well. Thank you and have a good afternoon.